Hi folks, welcome to my discussion on long-term debt. In this discussion, I am going to deal with how you calculate the price of a bond. So my goal is to understand how to calculate the price a bond will sell for at a variety of interest rates. Anytime there's a change in interest rates, the price of a bond will change as well. Let's learn how to calculate that. Let's start by reviewing a little bit about bonds. When a bond is issued, it's a contractual agreement where someone will issue a bond to borrow money. Someone else will buy this bond as an investment. In our example, I'm going to have an indenture or a bond contract that has a bond that has a face value of $10,000. What that means is that at the end of this bond's life, the person that issued it will be required to give the holder $10,000. The indenture will have a stated rate of interest on it. In this case, our bond is going to be a 10% bond, but it's going to pay interest semi-annually, as most bonds do. So it will be 5% per period. The term or life of our bond is going to be 2 years. Most bonds are 30-year bonds, so this is indeed a short bond, and it will also tell you when they pay interest. I'm just going to throw this on, though we don't need it for our discussion. It's common to have them pay every 6 months, and 6/30 and 12/31 are common ones the authors use because it makes the accounting just a little bit easier. So we now have an indenture with a $10,000 face value, 10% stated rate of interest, pays interest semi-annually. It's 2 years, and it pays interest on 6/30 and 12/31. Let's look at what cash flows that would lead to. So our bond is going to be a 2-year bond, and it's going to pay interest every 6 months. I'll put these little dots on here. Here's our 6-month point, end of the first year. Here's a 6-month point, and end of the second year. It's a $10,000 bond, and it will pay interest at the rate of 5%. Where did I get the 5%? Well, it's a 10% annual rate divided by 2, so that's 5% per period. 10,000, the face value times 5%, $500. So each 6 months, at the end of the 6-month period, this bond will kick out an interest payment to whoever owns it, amount of $500, or cause whoever issued it to pay interest on it. I said 4 periods because it's a 2-year bond, but it pays twice a year, so it will be 4 periods. We have an interest rate then of 5% and a number of periods of 4. So this bond requires that interest be paid every 6 months in the amount of $500, and at the end of its life it will mature and require a $10,000 payment be made. Whoever issues this bond has to make this cash flow stream payment to someone, and whoever owns it will receive it. It's important to remember that these cash flows will never change. They are determined by the indenture or the contract of the bond. To price the bond, we have to bring these cash flow payments back to the present. The $500 cash flow stream and the $10,000 payment at the end. We need to know what the present value of those are in today's dollars in order to attach a price to it. The $500 and the $10,000 determined by the bond indenture. And those won't change. But what does change is the market rate of interest. The market rate of interest, or yield, fluctuates regularly. It can change at any given time, and probably does several times in any short period. The way you figure out how much a bond costs is to discount those cash flows that you see that never change back to a present value using the current market rate of interest. If the market is currently yielding 10% and our bond stated rate is 10%, the bond will sell at par, or exactly $10,000. The bond is paying what the market demands. If the market yield is greater than 10%, our little bond won't be worth as much because you could invest and earn more in a different investment. So we'll have to sell our bond at a discount, something less. If the market is yielding something less than 10% and our bond is paying 10%, our bond will sell at a premium. In fact, the price of the bond will change just enough to make the market yield, or to make the bond yield exactly what the market's demanding. I would like to calculate the price of our bond at 3 different market yields. First, at 10%, which is what our bond yields, so they'll be the same. We'll discount it back at 5%, because as you recall, we're receiving interest twice a year. Then I would like to price the bond out at 8%. So the market would be yielding 8%, and we'll price the bond at 4%. And then I would like to price it again at 12%. So every 6 months, it's paying 6%. And you can see then how to calculate the price of this very bond given those 3 different scenarios. In scenario number 1, the market yield and the stated value are the same. So the price of the bond should be exactly $10,000. In order to price a bond, you need to do a little bit of present value calculations. You can do these with a calculator that does time value of money functions, or use time value of money charts. Our objective is not to learn how to use those 2 in these, but we're going to assume that you already understand you could do it either of these ways, or in fact use a formula. So we have to bring our $500, which is our payment amount, take the present value of that payment stream above, which is 4 payments of $500 each in their annuity. Look at that over 4 periods, because that's what we're pricing it at an interest rate of 5%. Where did I get that? Well, it's 10% divided by 2. The market yield is 10%. The bond yield is 10. Then I'll take the $10,000 payment at the end of the life of the bond, and through just one present value calculation, it isn't a stream of payments, it's a single. Still n equals 4 and I equals 5%. Whether you do that with a calculator or a chart or using the formula is irrelevant. So the present value of the $500 today is $1,773. It's not $2,000, which is 500 times 4, because you have to wait to receive each payment, waiting 4 whole periods for that last one. The present value of the $10,000 received at the end of 4 6-month periods is $82.27, when discounted for 4 periods, 5%. If you add these 2 together, you see that they total $10,000. And that shouldn't be a surprise, because I priced it using 10%, and the cash flow was at 10%. That would lead to a journal entry when you issue the bond that says, I'm going to get cash, I'm borrowing $10,000, and I'm going to get it right now, and I'm going to put a bonds payable on my books in the amount of $10,000. And when I make that first interest payment, it's going to be on the carrying value of the bond. The carrying value is 10%, and the bond was sold to yield 5%. And the stated rate was 5%, but now I'm using the market yield, so interest for that first period would be $500. Notice I'll have interest expense at $500 from the calculation I just showed you, and a credit to cash of $500. The credit to cash will always be $500 because that's what the bond pays. And in this case, the market and the stated rate were the same. Let's go through the same set of calculations now, where the market's yielding 8%. So the market rate of interest is less than the bond. So I have a bond that pays 10%, and the market's only demanding 8. I can charge more for that bond. It's going to be of greater value. So I take the cash flow payments that come from the indenture, the terms of the bond. Notice they're just like the last one. That's never going to change. And I'm going to take the present value of that cash flow stream for 4 years, but this time use an interest rate of 4% or half with my market yield. And I'm going to take the present value of that $10,000 received at the end of 4 years, discounted back at 4%. And when you do the math, however you do that, you'll find that the present value of that $500 payment stream is $1,815, and the present value of that $10,000 is $8,548. You add those two together, and they come up to $10,363. So I used the cash flows at the stated rate, but I did the discounting at the market rate. I'm able to sell the bond for $363 more, and that $363 can be used to offset future interest expense, driving it down from 10%, which it was issued at, and delivering it at 8%, which is what the market's demanding. The entry to issue that bond is going to be cash, $10,363, because that is how much I'm going to get. And then I'm going to set up a bonds payable with face value. That's the amount always gets put into bonds payable. And then I'm going to set up a premium on that bond in the amount of $363. That $363 is exactly the difference between a 4% semi-annual yield and a 5% semi-annual yield. When I calculate interest expense, I'll take the $10,363, which is how much cash I actually got, times it by my market rate of interest of 4%, and my interest expense for that first year will be $414. By doing this entry, I hope to help you see how that premium helps offset interest expense. So I'll say interest expense. You just saw me calculate it at 4% of $414. And I have to pay cash of $500 because that's what the bond will always pay. And the difference will come out of the bond premium. I realize I have abbreviated that a little. Bond premium, and the difference is $86. This 500 is 5%, the 414 is 4%, and the $86 is exactly the difference between the two. So I'm using that extra money I got from my bond to drop interest each period. Isn't that fascinating? I thought you'd find it interesting. Okay, I'll stop. Let's move on to 12%. Notice that in this case, our market yield is greater than what our bond yields. Our market yield is going to be 6%. Our bond only pays 5%, so our bond won't sell for as much money. It will sell for something less, something that will change the yield to the investor and the interest to the issuer to be from 10% a year or 5% semi-annually to 6% semi-annually. How do you calculate that? Well, you take the cash flow as always, from the indenture, the 500 and the 10,000 will always be those amounts because they're from the stated rate on the bond itself. Take the present value of that annuity, this time 4 periods, but the interest percent is going to be 6%, interest is, and take the 10,000 from a present value perspective only. It's not a stream of payments, just one, and use a discount rate of 6% on that. When you do the math, the present value of that $500 cash flow stream is $1,733. So that's what the 4 $500 payments is worth today. The $10,000 is $79.21 when brought back to today. Add those two together, and the price of this bond today is $96.54. The bond will sell at a discount. You use the dollar cash flow amount in the calculation, but you use the stated rate of interest to discount it. Let's look at our journal entry. When we first get cash on this, we'll get $96.54. And we'll set up a bond discount account. But the difference, in this case, the difference is $346. It's just the difference between the cash and the bonds payable. And we'll set the bonds payable up at what we always do, the face value of the bond. And we'll use that discount to help offset interest expense, or to make interest expense more in the future. We need to take it from 5% to 6% semi-annually. So that first interest calculation will be the carrying value of the bond, the $96.54 times 6%. And if you calculate that on out, $96.54 times 6% is $579. So interest expense on this first payment will be $579. The cash is always going to be $500, and we'll increase our interest expense by amortizing $79 out of that bond discount account, where we've cut the difference between 5 and 6%. So interest is at 6%. I want you to notice something. When the bond sells at par value, you get $10,000. When market rates go down to 4%, the price of the bond goes up. It's more valuable. When market rates go up from where the bond was issued, the price goes down. It's not as attractive of an investment to investors. So we learned how to discount the cash flows to come up with the price of the bond. Sometimes you see a shortcut happening. The author shows you the price of the bond without making you calculate it, or it's listed in the newspaper. A bond that sells for $10,000 is said to sell at 100%, and that means you could times the face value of the bond, which was $10,000 on the indenture, times 100%, and that would be the issue price. In the case of where we sold our bond for 8%, that would be at 103.63. You can see I've just truncated that number. What that means is take the $10,000 the bond was issued at and times it by 1.0363, and that tells you the price of the bond. You can tell, since it's over 100%, that it was sold at a premium. And then for the discount, if you saw this in the paper, it might say that that bond was selling for 96.54%. And you would know that you could take the face value of the bond, whatever it is, and times it by 0.9654, and it would give you the selling price of the bond. It would work for $10,000, a nice easy number. It would work for any number. You would just times it by this interest rate. It's a fast way to say the price of the bond without going through all the calculations we did. Hopefully this helps you understand how to calculate the price that a bond will sell for. Thanks for joining me. Bye.